Hi, everybody. This is Hyperwave. I am Leah Wald. We have Tyler Jenks here, and I'm really liking going after closing bell. We are going to be doing this every day, especially as Bitcoin's pretty boring still, but the stock market is not. And actually not the first time, but we're going to start talking about international markets as well. Now, today we had a crazy time in the markets. I'm sure that all of y'all were watching because you are watching a trading show. Alphabet, Intel, Amazon, we're definitely going to be talking about all of them. Everybody beat on earnings, but Alphabet and Amazon didn't beat on revenue. Although, as Tyler was telling me before the show, he does absolutely believe that this should carry through until tomorrow. So a lot of interesting stuff going on, so we should chat about it. And before I turn it over to Tyler, little trivia. Who knows what this is? Okay, that's a trivia for the day. Tyler.
Great. Hi, everybody. We're going to expand the number of things we look at today, which means we're going to have to go through them quickly. It's been unbelievable after the close today, the number of earnings that came out, and almost everybody beating big time on earnings, and the big two, Amazon and Alphabet, beating on earnings big time, but did not hit their revenue numbers. And so trading down 4 or 5%, both of them coming back. We'll see what happens in the next several hours. But everybody else, Chipotle, Expedia, Intel, Snap, kind of blowing it up, Gilead Science, everybody doing fabulously well from an earnings and a revenue point of view. Okay, what does all this mean? We had a big update today in the markets. We're going to take a look at countries to get a sense of that, and I'll explain why as I'm going through them. Then we're going to go to the U.S. indexes. We're going to go to U.S. sectors and some new industries like home building, which we didn't talk about the last couple of days. Then I'm also going to give you a list of leveraged ETFs, both long and short, and we'll take a look at how they're doing in this marketplace. And then we will conclude with how I interpret all of these as we go day by day closer to midnight, which is going to be October the 6th, November the 6th, the election, and how all this plays together. So without further ado, because we have so much to cover, we're going to start with the world. There's a tremendous analyst down in Australia whose name is Colin Twiggs, Twiggs. You can subscribe to his service. I have for many, many years. And he has his own technical indicators, the Twiggs money flow indicator, which is very, very powerful. And you can just look him up. And if you decide you want to subscribe to him, that's fine. I think you'll learn a lot. But he sent out a very interesting notification today, sort of country by country around the world, of what's been happening as the US markets have gone down. So I want to start with that today. So we will do that by...
Hey, Ty.
Yeah.
We should show the webinar afterwards.
We will definitely do that, and all the way through this, because after just talking about it in our last vlog, we've had tremendous interest with people signing up, keeping Leah busy all day long, getting back to everyone. But the timing of this could not be better, and it's going to be a very important session on November the 3rd. Let's start by going to the application window and yes.
While you pull that up, what you just did, just letting everybody know so that you let me sleep a tiny bit. If you go to our website, Lucid Funds, you go to webinar, it has all of your beautiful information, and you will now actually, well, actually, I had that wrong. You will have it for 30 days, actually, and that's going to change in literally 1 second. And you have all the links, and you tell me that you did it, and bada bing, bada boom, you're in. All right. Now, Tyler.
Terrific. Let me see. Let me do this. Thank you for that. Yeah, if you just go to our website at lucidfunds.com, you'll see a new website, but you'll have all the information about what we are doing on November the 3rd, broken down by hours like we did it before. Okay, let's bring this guy up. And can we see that?
Just needs to go larger. Do the full screen. Maybe if you say boom bada.
Boom bada.
It worked.
Okay, we're starting with the UK, and they were up about 0.5% today. You see that it's basically in a full bear market, as many of our indexes also are, or close to them. Everything is down. I would say the long term is still hanging in there because of all this action before, but unless it can hold these lows, we're probably going down fairly big there. We are going to look at Japan. Japan has held up much better until the last 3 weeks, especially this week, and then all fell apart. Remember, the US leads all the other indexes, except those such as China, which are in a world all their own. But most of the Asian, most of the South American, most of the North American, and almost all of Europe followed the US lead, and therefore you would expect all of this to be about the same. This is not Japan in such a horrible position, but at 21,000, this is the lowest close we've had since March, and things are turning down very quickly. So unless these markets, led by the US, begin to bounce like we did today, these are not looking good. This is the DAX in Germany, everything down, price below everything. This is Australia, everything down, price below everything. This is Brazil going the opposite direction. Elections, they had been going down where no one else was going down for a long time. And now all of a sudden, we've been talking about emerging markets maybe getting their act together. This one certainly is and could be bought. It's not going to take long for the intermediate term to cross the long. Too early to say that. You do it a piece at a time, but you should definitely be approximately 25% long in Brazil. So that's one good one. This is China. Needs no explanation. This is small cap China. Needs no explanation. This is Germany. Needs no explanation. This is Hong Kong. Same. This is India. Same. This is iShares MSCI India. I just wanted to check this against the EPIs, which are called the India Earnings Fund by Wisdom Tree. And this is the India Fund, THE. The reason I'm spending a lot of time on India is because where Brazil, as an emerging market, even though it's one of the largest in the world, as is India, India is going the opposite way. And then this is the MSCI Japan. So, very quick look, and you've got a mental picture of across the globe that what has happened in the US is being mirrored around the world. Okay, which brings us to the US. And let's start with the indexes. As I started out by saying, and all of you know, we had a big rally today. The Dow was up 400 points, 1.6%. And it is attempting a bounce. We'll see how Alphabet and Amazon affect that. We will look at Alphabet and Amazon and a bunch of other stocks as well as sectors in just a moment. But other than that, we are in a major downturn, still highs above highs, and three lows rising. This would be a wonderful place for this to stop going down. We've got a pretty long wick below this week, which closes tomorrow. Coming after all of the earnings reports today, it will be very interesting to see what we're able to hold on to, and if we're able to actually close above the long-term moving average, which is still moving up on the Dow. On the S&P, the long term is still moving up, but we're completely below it. We've got a pretty long wick. It needs to be a lot longer so that going into next week, we've got the possibility of turning this around. The Nasdaq 100 long-term moving average still moving up, 2 candles below it, closing tomorrow. Still quite a bit to go to get the intermediate term to cross, but prices have got to get moving. And we've still got 2 weeks or a little bit less until the election. This is the Nasdaq Composite, 3 weeks below. The intermediate term has not come down yet, but is falling fast. Attempting to hold the support from the earlier lows in the beginning of January and February. So far, we've been able to do that, but as we said yesterday, this is not looking good. The transports have put in a pretty decent day today, up almost 2%. By the way, the NDXs were up 3.3% today, and the Nasdaq Composite up just about 3%, 295. The Dow Jones Transports are up 188 today, and this is the Russell, but I don't have this updated for some reason. It's still showing it down for the day, which is not correct. I don't have the actual number on that, but we said yesterday we've now got 3 full candles below the moving average. The moving average is moving sideways to slightly down. And we said you should be completely out of this one with the anticipation of the long-term moving down. Okay, let's take a look at the sectors. And I've added a couple of things here. So let's just start at the top, which is consumer discretionary or consumer goods. A little bounce today, 1%, and attempting to turn around, but right now all three of the moving averages are to the downside. We've crossed the intermediate term below the long term, which is slightly moving down, and we are trying to get back to it. This is consumer services or consumer staples, basically up 3% today and moving sharply above the lows. And the close so far, we've still got a day to go, is back on the long-term moving average, which is moving up. The energy was up 1% today, but hardly a bounce relative to the other ones we just looked at. The long term is flat, but we have crossed below the long term, and this is not looking good. These are the financials, have crossed below the long term. The long term is moving down, and we are well below them. Very difficult to get back up, even on a strong bounce. They were up 2.28% today. The healthcare is still looking good. We broke down below the long term during this week, but now we're above it. And that could be very helpful. We were up only 1.27% today, not as strong as the several of the others that we've just looked at, but it's in a better position, even though the intermediate term has cut through, but this is one that you could still be mainly invested in. It's not at a 50% cash level at this point. The industrials are looking very bad. We have not had the intermediate cut down, but the long term has already moved down because of the size of the drop below it. And it is very similar to a bunch of these other ones we looked at. This was very interesting today. This is the only sector that was down today, which is the strongest of the sectors in the downturn, which is the utilities. It was down 1.4% today, but still price above all the moving averages, and all the moving averages moving up. So even though we had a slight pause, it's a wonderful place to be hiding until all of this other stuff gets cleared up in the next 2 weeks. Telecommunications was up just about 1% today. We've got a decent wick. I know you can't see these wicks, at least I can't, but the bottom of the wick is down here. The bottom of the previous wick was even lower 2 weeks ago. And we've got the short term now cutting through the long term, a long way to go before the intermediate does. This could save itself, but it needs to get going. Now, a couple of other things that I've added to this pot. Yesterday, we looked at oil. This is WTI crude oil, which was less than 1% higher today, but everything is kind of meeting at the same place. This could easily turn around. Right now, we've got lows, above lows, above lows, above lows, and above lows. The problem is we've got this double top going, but this is the kind of a formation that can easily break up to the upside, depending on what goes on with Saudi Arabia and its relations with the U.S., basically. Okay, here are the home builders. We haven't shown this one before. You've seen it on CNBC and a lot of other places. It's been a disaster. It really led a lot of these other sectors and industries and indexes lower because nobody could really figure out what the heck was going on with it. Just kept falling and falling and falling. It's in a clear bear market. but we were able to go up almost 3% today, which is leaving this little doji that could be a turning point. You'll have to watch the sequential with tone and see what kind of account. Some of you have already got that, but this is looking interesting. I would not have any money in it at this point because I need all of these to come and turn around. But if prices can start working its way up, then that might be a precursor, since it let everything down, to something that might look a lot better 2 weeks from now. And finally, I wanted to just do a sector fund of technology in general. This is the Spider Select XLKs, which was up 3.5% today and is struggling to get back above a rising long-term moving average. With the intermediate term well above it, it could be the kind of thing that could also turn around at the beginning of another move up. That's a lot of ifs that I'm throwing in there, and I'm not drawing any conclusions. It's way too early to do it. We're just taking a look at what prices are actually showing us as of the close today, one day before the close of the weeklies. Okay, we looked at some industries before, and I've just picked out some things that I think are fairly interesting. This is the biotechs, the BBHs, which had been very strong. And now we've got the short term breaking below the long term, and we've got this huge candle to the downside, and a little bit of a wick forming here with only 1 day to go. That's one of the reasons that healthcare in general is struggling, if you consider that to be a industry within the healthcare area. This is an internet ETF, XWEB, and as you would assume, it looks very similar to some of the Nasdaq stuff. It's actually a lot stronger with the long term still moving up, and not too much damage here with a long wick, with the short term coming right down to the price. So this is another one that could be on the verge of turning around. Tomorrow is a very important day following all of these earnings, and going into the 4 o'clock close. We will do another vlog tomorrow, even though it's a Friday, after the close, just to see how much of this stuff can continue. By the way, every one of these industries was up between 1% and almost 4%. The XWEB today, the internet ETF, was up 3.5%. Okay, the PPHs are the Vanek pharmaceutical ETF, and doing a lot better than the biotech, and trying to hold the long-term moving average, which is moving up. Everything else is coming down. Tomorrow will be important for that. It was up about 1.25% today. This is regional banking, and this is not a good sign for the economy in general and for the stock market specifically, because it is relentless to the downside in a full bear market. These are not the big multinational banks. These are the U.S. regional banks, and you can see they are in a full bear market. But they were up 2.62% today, but there's nowhere for them to go because all of this is coming down rapidly. That concerns me almost as much as anything else we're talking about. This is the Vanek Retail ETF, and is very different than some of the other retail things that you've been looking at. Vanek does a great job in putting together ETFs, but you need to look at what elements are in here and how they're weighted. But as it stands today, they were up 2.5% after slicing slightly through earlier in the week the uptrending long-term moving average. And everybody, I think, knows I'm using 330, 3, 7, and 30 on all of these charts. 3 on the short term, 7 on the intermediate term, and 30 on the long term, which basically is the same as a 14-day, a 50-day, and a 200-day, give or take. But they're ones that I've used for a long time. So I like this one, and that's saying something about the consumer, but you have to look at other retail indexes to get a better picture. These are the semiconductors. This is very worrisome. This is what basically is leading a lot of the tech down. This also is a Vanek. It's SMH. It was up almost 3% today, 283. But just as we said with the regional banks and some of these other industries, is in a full bear market and very difficult to pull out of this tailspin, which is telling us something. I just wish I knew what it was. Consensio will tell us piece by piece as these things either strengthen or weaken. We'll get a clearer picture of what the index is and therefore what various countries should be doing and how significant all this is to the overall macroeconomic picture. Now, one of the other things I wanted to do quickly is go through an expanding list of stocks because Amazon, well, let's start with Tesla. Everybody knows their earnings came out. They were terrific. That was yesterday. It's turned a very bearish situation into a much less bearish, but not yet out of the woods situation. But we've actually got an uptick because of the strength of this. Today, Tesla was up 9%, 26 points to 314, and it hit 322 at one point in this big surge. And because it closes tomorrow, this could be looking very good. This is going to pull the short term up above the intermediate term very quickly, meaning tomorrow. And the intermediate term is already turned up simply because of the price action. So that's interesting, but it's a one-off. It doesn't represent the autos. It represents Tesla. But for those of you that have been in Tesla, we bounced off of 250, which is a very important support level on a couple of occasions here and back here and even further back. So 250 has been an area that I've been watching for a long time. And we've seen these bounces off of it before. This one is based on earnings and revenue, however, that just blew all of the analysts apart yesterday. And it could be just short covering, but we will have to wait to see. Let's take a look at Amazon. Amazon was up 7% today and was able to bounce off of its uptrend long-term moving average. But then in after hours, it was trading down 5%.
Hey, Ty, I think you're.
Excuse me?
Oh, you're back.
Okay, good. Sorry. I was just trying to get a current price in after hours. We had moved from almost 6% down to only about 3.5% down in after hours. But it would be great if Amazon tomorrow could stay above its long-term moving average. I think that will help a lot of the other stocks. Google also beat on earnings big time. Revenues were a little bit shy, and it was down, but not down a lot. I see Amazon down 7% right now, and Alphabet down about 4%. So on Alphabet, we've got long wicks below each of these weeks, but tomorrow will be very important because we will finish the week out. And we've got the intermediate term coming down to meet the long term, which is still moving up. Microsoft was up 6% today and is bouncing off its long-term moving average, looking very good. Cisco, 3 weeks in a row, bouncing off the uptrending long-term moving average. It was up 3% today. Comcast up 5% today, and trying to reestablish an ugly looking chart that bottomed out in June. And now the long term has turned up. The intermediate is turning up. This is another place to hide in the tech area. FDX, I talked about yesterday, had me worried, still has me worried because of its implications for the movement of goods in the US. It was up 2% today, but still is looking in a fully bearish posture here. Intel up 4.46% today, taking it back to the short-term moving average, but we've got the long-term turning down and is not looking good. Netflix up 3.6% today, and I'm going to take this back to the beginning of the year. This is a break, as I said, of a phase 4 hyperwave. This was a phase 5 that broke the uptrend line. Phase 6 took us back above everything, but now we are quickly dropping away, even though Netflix today was up about 3.5%. Too early to make a call on what the implications of this is for the tech sector. This could be a one-off because so many of the other tech stocks are attempting to put in bottoms, it would appear. Square was up 6% today, 3 weeks in a row above the uptrending moving average. This is Micron Technology in a full bear market, but it was up 4% today. AT&T, very disappointing. It was down today, 1.25%. Things are not going well there. This was an attempt to turn around this downtrend, and then you see what is happening this week. A Biomed was down 5.5% on a very strong up day, and things are about to look very bad for that. With even though the long term's moving up, we've got the intermediate term coming down very quickly. And finally, BlackRock, we talked about that yesterday. It managed a 3.5% bounce, but didn't take it anywhere except to have a long wick at the bottom, but looks very bad. Okay, now what I would like to do, and we've blown through this in a fairly short period of time, but not as short as I wanted to, is I want to give you a couple of other new things in terms of leveraged funds. Now, this is the QIDs, which is ProShares Ultra Short QQQs, 2X. And we talked about how it's moving opposite, obviously, but at a much faster rate. And today, this was down 7%, 6.76%, because we had a big up day. But twice what was gained in the stock market was lost in this. I wanted to pull these out because I know some of you are trading them, and some of you are trading them aggressively. But for others that are tempted, the size of these moves are twice the size of the moves on their underlying. This is the S&P 500 ultra short, which has been doing very well and was a way to protect your long positions without selling your long positions to raise cash. You can raise 1/3 the amount of cash and put it into a 2x fund. But as I said, you get big counter trend moves when the stock market goes up. And you've got to know that and watch it and understand that before you put significant money into these kind of things. This is the MZZs, which is the ultra short mid caps. And they, as we showed yesterday, were doing terrifically well because the small and mid caps were doing very poorly. Today, it was only down 2.5%, though, because there wasn't that much move on their underlying compared to the big indexes. This is the Dow 30 ultra short, not yet back above its long-term moving average, but getting there very quickly. It was down 3.3%. That's the DXD. These are the ProShares ultra short Russell 2000. You heard what I said about the Russell 2000 a couple of days ago. You should be out of small cap stocks. One way to have done it is to sell 1/3 of your position, put 1/3 of that money or 1/3 of your cash into this, and you would be completely hedged for the last 1, 2, 3, 4, 5, 6, 7 weeks. So that's just a clue, but my warning is there are tax implications and also tax opportunities by not selling long positions that have big gains after the last 10 years. But these positions you're not going to hold for a long time, so you'll be forced to take big profits out of this side of your portfolio. Just know that and understand what the implications of that are. Now, I've got some clients that are trading SQQQs, which are the ProShares Ultra Short Fund. This is actually a 3x, and I just put it here because some people are trading it very effectively by assuming that the Nasdaq was going to continue lower, and so far that is true. However, this fund, this ETF was down 10% today. Why? Because the Nasdaq was up 3%, and this moves at 3 times that speed. So when you're in these things, if you're not using them to hedge positions, in which case you don't care which way either the market itself goes or these are going, because it's part of a portfolio that is hedged. And you can sit in that hedged position regardless of the direction the market moves. Just know that if you try to only play these on their own, that you can get burnt very, very quickly on a day like today. This is the ultra short, ultra pro short mid cap. It was only down 2.76% today, and the same thing with the Dow, down 5% today. Okay, that took a long time, but you can play this back, and if you're playing it at 2x or 3x or whatever YouTube allows you to do, because I speak so slowly, you might want to slow it way down so you can take a look at these charts and these symbols, and hopefully they'll be helpful. They will be very helpful if you join us for our portfolio seminar, which will be on Saturday, a week from the day after tomorrow, in our webinar. And I am going to get out of this and go back to this. So that I can turn it back over to Leah. And are you there, Leah? There you are.
Thanks, Ty. Okay, are you ready for some questions?
Yeah, let's take some questions. And then I said I was going to make a couple of comments. We've had a lot of people already sign up at a faster rate than we did on our first webinar. We have expanded it, but we do have limits. So the faster you can get into it, it is $150. It will be 3 hours long plus an hour of questions afterwards. You'll be able to access that for a full month afterwards, because we're going to go through a lot of charts, but a lot of portfolio theory. And we're asking people if they would send us the name of a stock. I am going to build a random portfolio from the stocks you send us, so we can analyze that relative to various ETFs, mutual funds, and closed-end funds to show the differences between random portfolios, such as most people have in their own lives, compared to ones that you know what's going on or who the managers are, to see what the difference on the risk and the rewards are at various turning points in markets, to help you to visualize what it means to have a portfolio with 10 stocks that you've picked, 2 or 3 ETFs that you've picked that are themselves portfolios, 2 or 3 or 4 or 5 mutual funds that you've picked in either retirement accounts or your own personal accounts, and how all that interacts during various phases in markets. And we will spend a lot of time going over that, and I will be quiet and turn it back over to the lovely Leah.
Thank you, Ty. Hold on. Okay. Given that your mustache looks really nice today, I mustache you a question. Yes, live chatter just won that one. Okay. Would you say that this downturn is being driven by an uncertain political environment?
Yeah, great question. I've said that for over a month now, and I have to admit that talking with some of our consulting clients today, by the way, we are closing down our consulting program as of the end of December. We do have room for some more, and I'll explain why at some later time. But we can't take any more after that. If we hit a particular number before the end of December, we will cut it off. I've been threatening to do that the end of October, the end of November, but we've got space. There's about 25 of our clients that are not active because they simply want to know when to buy Bitcoin. And because I'm not ready to buy Bitcoin, there's no reason for us to be doing any consulting. And we'll explain all that. If you're interested, just go to lucidfunds.com, and on that submission sheet, just say, when you send me information about the webinar, please send me information about the consulting. And Leah will take care of that. Okay, so the question is, I keep saying that this is a political activity, and it is not based on economics or earnings. What I see on the earnings picture is that is very much true. We were up 21% in earnings for US corporations last year, and the stock market was up 22%. Perfect. That's the way it's supposed to work. This year, we're up another 20% in earnings for this year, and the stock market is flat. That is not the way it's supposed to work. Something else is at work. And I have been saying, I think that something else is purely political, because of the upcoming midterm elections. I still believe that. However, the reason I showed all of those country charts is those country charts don't have the same political problems we do, and yet they are in a major downturn. That tells me there are macroeconomic forces at work. And I've been trying to put those concepts together in my mind, and I still believe 75% of what we're seeing in the US markets are based on the upcoming midterm election. The fear of uncertainty of what that's going to mean, nobody knows. But 25% now I'm willing to concede is based on the fact that my assumption has been for the last 3 or 4 years that the strength of the US economy and stock market would keep the macroeconomic picture in check around the world. I'm now beginning to doubt that. I'm beginning to doubt it because of what we just looked at the countries going into bear markets. Now, the analogy, the metaphor I've been using is the US is the engine for macroeconomic growth around the world. And it's pulling behind it 220 very heavy cars. The biggest cars they're pulling behind it are the European countries and the big developed countries around the world that some people still say are developed or developing as opposed to emerging, and then a bunch of emerging markets at the end of the train. And the US has been able to successfully do that for years now because of the strength of the US economy and the US stock market. I'm now beginning to doubt that strength, the size of the engine pulling all of that dead weight meaning before we turned down, we were up between 7 and 10 or 11%, depending on the indexes. We're now flat. We've given back 10%. All of the European countries in general were flat while we were up. There was a 10% disparity. There's a 10% disparity between us and many of the bigger countries like China, which is down 20% when we were up 10%. That's a 30% differential. And because of all of that weight, it's becoming more and more difficult for the US on its own to keep pulling everybody up. And that changes the picture for me. But it doesn't change it more than 75-25. 75% tells me that it's a political problem in the US that will be solved in a very short number of days, specifically 3 days after our webinar, going into the details of how all of this works for portfolios, both internationally and nationally, and how you need to think about it in terms of what will happen 3 days later. Here is my assumption. My assumption has been, until what I just said is new information to me or a new light bulb going off after looking at hundreds and hundreds of charts, my assumption has been that if the Democrats take the House, they will be in a position to start impeachment proceedings immediately, which will tie up the Trump administration for the next 2 years so that no new fuel in terms of economic incentives, tax cuts, trade deals will be able to occur easily after the November election. However, the strength of the US economy is still there. The earnings are still there. We're seeing them tonight after the close. Revenue growth, earnings growth is still there. And I believed until this new revelation about maybe 25% of the problem is actually the inability of the US to pull everybody else along with it. My assumption was that if the Democrats take the House and tie the Republicans and the administration in knots, for the next 2 years, that we would still have a reasonable possibility of pulling everybody else along with us. I now have doubts about that. The other side of the equation is if the Republicans lose seats in the House, but gain seats in the Senate and don't lose enough seats in the House to lose the House, that the strength of the US economy and businesses looking ahead to the next 2 years of more of the same that we've gotten in the previous 2 years will be enough for the US markets to turn around and go up and maybe be strong enough to pull a lot of the world with us. Those are huge assumptions. Many people will say they are stupid assumptions, but I just want to let you know that those are my assumptions at this period of time, and why every day we are going to be doing these logs to cut through the assumptions and the opinions and look at the data. Let's see day by day leading up to the election what is actually happening in the US markets and in the world markets. And we will let Consensio and Hyperwave and Sequential and all the other things that really are important, because they cut out my opinions, your opinions, and they just tell it like it is. So again, I'm saying all of that because of how important I believe this webinar is going to be. Please, if you are at all interested in these viewpoints and the evidence that we're able to glean from 40 years worth of looking at portfolios and trying to understand what they mean and what they do, join us by going to lucidfunds.com and just asking for the information. That's all you're doing. It will tell you what it's all about and how it's going to work, and Leah will take care of all of that, and she hates it every time I say that.
Actually, I love it, guys. It was fun waking up to 85 emails today. Thank you. No, it was. I actually do really like it. It's a lot of fun. It's humbling to see how interested you guys are and how much you listen to Maestro Tyler. So actually, I actually do like it. Okay, Tyler, a follow-up to that I'd like to take.
Great.
So, and especially because you know my love of behavioral economics, but this really is just a follow-up straight up to what you were just talking about. How much is it political anxiety versus wider global contagion taking over versus simply rising rates?
Yeah, great question, because a lot of people are putting a lot of weight on rising rates, and I think improperly so. One of my strengths, I've got lots of weaknesses, but one of my strengths is having to do with Federal Reserve policy and interest rate movement, and which comes first and which comes second, and what the long-term trends of interest rates mean. That comes from my Hyperwave work, where I quickly recognized after the peak in interest rates in 1979, 80, and 81 that we were in for a tremendously bullish period for stocks and bonds, because interest rates had finally broken a 40-year cycle of upwards movement, and we started a 40-year cycle of downwards movement. And if I hadn't discovered Hyperwave several years before that, I wouldn't have recognized it, but it led me in 1985 to write a piece called The Case for Bonds, in which I predicted that the next 20 years at least would be lower and lower interest rates, therefore higher and higher bond rates. And that means more and more money for pension funds and for savers and for everybody else, because bond prices would be increasing faster than the interest rates were going down until they finally hit a bottom. I also recognize that Federal Reserve policy does not lead market activity in bonds. When the Fed starts raising short-term interest rates, it's because the market already has moved short-term interest rates higher and the Fed plays catch up. They say that interest rates are going up because we're moving the short-term rate up. But if you take a look at 30-day T-bills that are traded in the marketplace and commercial paper and 180-day T-bills, you will see that they always precede Fed action, not the other way around. So people that are upset about the fact that the Fed's on a path right now is irrelevant to what's actually happening with interest rates other than the short-term interest rate. Right now, short-term interest rates are hanging around 3.15% on the 10 years, and the short terms are down at the 2% level. This time before the 06, 07, 08, 09 downturn, which was strictly because of high rates and too high rates in terms of mortgages and other things that had been artificially brought down by prices going up, we were at 6.5% 10-year yields. We're half of that right now. There is no reason for an economic activity in the US to slow down for many, many months, quarters, or even years at the rate the Fed is going. And because inflation is not going up faster than the productivity and the GDP and the growth rate of the US, we don't have to worry about inflation, which is the thing that usually sets fire to the hair of the Federal Reserve officials if inflation is getting out of hand because of too much activity in the markets. We don't see that. Therefore, my answer to the question is, even though it's an interesting phenomena that is coincident with what we're seeing in the stock market, it is not playing a role in my estimation to the volatility that we've seen in the stock market. What is playing the role is the political side, and I'll give that 75%, which will be over in 2 weeks. And I'll give 25% to this new theory that I have that maybe the inability of the US to pull 220 nations along with it is waning, either because of the weight of the cars that are filling up with goods for those 220 nations in the form of friction, which slows down the train, is making it hard for the engine to act by itself. If you disagree with that, send me the name of a country that is helping pull this train. Give me another engine somewhere. Is it China? Is it Japan? Is it India? Maybe Brazil, but look at where it's coming from. So unless you can answer that question and give me a second locomotive or a third locomotive, this train could be stalling out. And I'm giving that 25% to the volatility issue.
Thanks, Ty. What do you think about we're going on an hour, but there's one last follow-up to what you were saying that I do think is a really great question. How do you feel?
Absolutely. I'll go all night.
We'd have to start charging everybody. Just kidding. Kidding. We've been getting in trouble with that recently. No. Okay. Great question. So, okay. What are your thoughts about the 1-year LIBOR? I can never pronounce this word.
LIBOR.
Yeah, in USD rate and how it's correlated to the 10-year Treasury bond. And the live chatter's comment or assumption is that debt appears to be the problem globally. ...
Debt is the problem globally. Debt is what's going to end this boom. A 10-year boom going on to be the longest in history. Some people say it's already the longest. I heard some people today say that it wasn't. But the point is that if Europe begins getting its act together, but they can't because of the debt, if other countries get their act together, but they can't right now because of the debt. The debt is the question, debt and credit. How much is there? How heavy is it? And every time you incrementally move interest rates up even 0.25%, that's going to be more interest that has to be paid on the debt. As long as we can grow faster than that growth, and the only one doing that is the US because of these unbelievably powerful tools that Trump used and nobody understood. If everybody starts adopting that, which is quote unquote capitalism, low taxes, less regulation, let businesses figure it out, don't let governments and groups of people figure it out or groups of countries figure it out, make everybody figure it out themselves, come to a conclusion and change things. Stop spending so much money and start earning money, start growing money, stop spending money mainly through governments. That's the whole thing that Bitcoin is based on, the ability of governments to print money out of thin air. That's what the problem is. Now, the original question had to do with LIBOR, the short-term trading rate that was completely manipulated for years and years and years and years, and finally some people went to jail about it. It's simply a mechanism to say what the very shortest term rates are going for. And so much of our real estate in the United States, so many of the deals that are made in terms of adjustable rate mortgages were based on LIBOR, including my own real estate holdings for years. And then we found out it was all manipulated. Now, Tone and I disagree about manipulation taking place in various markets around the world. He firmly believes that it doesn't take place in general. And that's the one subject that he and I are 180 degrees out on. I am unfortunately very cynical, and I believe every market is manipulated. Every market, including short-term interest rate markets. And it turned out that was true. And I believe the gold market and the silver market. And that has been proven over and over again to be true in many, many ways. And I'm going off topic. But what my point is, you're looking at the wrong things if you're looking at LIBOR against other more formal indexes. I don't decide LIBOR. You don't decide LIBOR. The Federal Reserve doesn't decide LIBOR. A small group in London decides LIBOR, and it turns out they were playing games. Are they now playing games? I don't know, and I don't care. I don't watch LIBOR. I watch things that have been around for a long time that I can trust and I can believe in. But don't look at the short-term stuff. I just said that short-term real rates that are market determined, such as T-bill rates, where there are buyers and sellers, the Federal Reserve doesn't move T-bill rates. The market does by buyers and sellers. Commercial paper, short-term commercial paper, 30-day, 60-day commercial paper is determined between you and me. If I want to buy it, you want to sell it, we will do it, and that will determine what the rates are. But other than that, the longer you go out, the more useful the interest rates are because they are market determined between two parties or two countries or on and on and on. So I like to stick with trying to understand what the debt credit problem really is from the perspective of rates that are really used in commerce. And that's where you get into the 10-year rate, the 5-year rate, the 3-year rate, and bonds of those lengths. And all bonds are, is there a piece of paper representing debt? There is someone on one side of it and someone on the other side, and they have to agree And if rates go too high, the one on the other side doesn't want to borrow it. And if they go too low, nobody wants to lend it. And so that's market forces, that's capitalism at work. And forget the little groups of people that like to make decisions for all of us.
Thor was getting riled up on that one, so he just decided to chase his tail over there. So I got a little distracted. Okay, great one though. We have one last question for you, and it seems to be consensus within the chat. So since we are Bitcoiners in the end of the day, how can we go against consensus? So this is a consensio question, if we could end on that tie.
Great.
Woo, whoopee. As you like to say, wait, do it once for me.
Bada bing.
Boom bada. When consensio trigger points reverse to upside, do you go in with the same amount in cash you took out at that point, or with the same percentage of total cash plus asset that you took out at that point?
I was thinking about that last night because I haven't explained that very well. I have, and we're going to talk about that in the webinar, because it's a missing piece when you look through all of our vlogs, or you look at even the Consensio vlog, but it's not a missing piece if you put it all together the way I look at the world. The way I look at the world is I don't ever want to use cash. I want all my cash all the time. I don't want to put it in something that is riskier than cash. But my business is putting it in something that is riskier than cash. Okay. Also, I'm not interested in short-term in and out trading. I'd like to look at long-term trends of things. There's two types of long-term trends, an uptrend and a downtrend. But they both imply something very different. A long-term downtrend means I'm in cash and I'm very happy and I'm very comfortable. And I'm not going to jump in and out trying to find a bottom. I'm going to let technical tools tell me when a bottom is actually forming. The other trend is a long-term uptrend. My cash has been taken away from me. I've bought into the picture of a long-term uptrend, whatever it is, gold or Bitcoin or the stock market, it doesn't matter. Real estate, it doesn't matter. But my precious cash that I've worked my life for, some of you have inherited some of it, most of you have worked for it, some of you have married into it, some of you have won a lottery, it doesn't matter. Once you've got it, you've got to steward it very, very carefully. And that means in a long-term uptrend, if you use Consensio, take your time using the rules. If it says to put 5% in, give it another day or so or a week or so, and then put 5% in. Everybody will point and laugh at you and say, oh, you're late. You're putting your money in after it's already moved. Great. That's exactly what I do. The next 5%, the next 5%, the 15, the 10, the 15, that takes it from 15 to 25, the 25 that takes to 50, and the final 50, now all my cash is gone. And I'm very uncomfortable. And that means I start looking very carefully for the end of that uptrend. And I'm going to start doing things quickly the other direction. Why? I want my cash back. I want to get out of this crazy thing that news items, whales, countries, Federal Reserves can take away from me in an instant by doing something, as opposed to the cash. So, great question. And the answer is yes, the rules are the same. 5, 5, 5. You can make it 10, 10, whatever you want. Mine is 5, 5, 5, 10, 25, and 50. But I will do those reluctantly at the beginning of an uptrend. And I will do it very quickly at the beginning of a downtrend. Even though the rule says this just crossed this, I need to do this. I'll either do it before that or after that, depending on which way the trend is going. Great question.
Was a great. And does that mean you want one more, Ty?
Yeah, all night long.
Okay. All right. Last one. And that's only because of the brilliant questioner. So we're going to throw in his second one.
Yeah, before you get into that, I am blown away by the quality of thought by various groups of people that Leah and I have been blessed to interact with, starting with our Hyperwave research group. Every day they are posting things that I've never seen or thought about before, just coming from left field, but the context is so incisive and brilliant that it's really fabulous. Secondly, the clients that have signed up for consulting often teach me more than I'm teaching them. Now, I've got a lot of experience behind me in a lot of things, so I can bring context to what they're saying. But again, these are just remarkable people to be working with. And then finally, just on these YouTube videos, there is a tendency, and I've listened to all the other people that do the same thing that Leah and I are doing, and they're swamped by trolls and negative, mean-spirited things, people trying to disrupt them. We almost get none of that. This is the neatest thing in my life. I am just thrilled by the kind of people we're meeting. And then finally, are you kidding me? In the webinar, we thought 20 or 30 people would be interested in this, and all of a sudden we blow through all of the ability to deal with people. So thank you all very much. We really respect your views, and you can tell by the quality of the questions coming in. Okay, sorry, back to you, Leah.
Thank you. Yeah, I couldn't agree more. And plus, I'm the one that checks the live chat all the time, and honestly, it's so much fun. You guys are really wonderful. I have imposter syndrome on the show every single time because of how brilliant absolutely everybody is. So I'll hide myself, and also I will totally embarrass Tyler and I. When we started these YouTube videos, we thought it would just be our family that watched it, and we were hoping for maybe 15 people. There is a bit more of a backstory, which is just, and I will just say right now, is that when Tyler called the Hyperwave for Bitcoin, we talked, and I was like, Tyler, we should put this as digital permanence. So if you guys ever go back, every single call is completely correct. But that was really just to make digital permanence, and we thought just our family would watch it. And I will say our first one, please don't go back, but now everybody will. I even tried to write a Bitcoin in the back. It was really lame, and it was the wrong direction. Not a B cash situation, but literally the B went the other. I mean, it was all sorts of bad.
Yeah, luckily nobody saw it for the first week, and then all of a sudden there were 10 or 20 people. And then all of a sudden, we just couldn't believe it. So thank you all very much.
Thank you, guys. And with that said, Ty, last question from the brilliant JL. Ready?
Yep.
And it's a nice open-ended one. So thank you, JL. So, and he is already prefacing by saying, is his assumption correct or not? And if not, are there other reasons? So here we go. On a long-term view, and he's defining that as multi-decade, is the global stock market with positive expected value upside due to these reasons: 1, population; 2, productivity growth; and or actually he has and 3, devaluation of fiat.
Wow, great question. And unfortunately, I can answer it very quickly because I had a partner for years who was a brilliant engineer. He and I came up with this system called the Celgene trading system that we haven't talked about, but we will at some point, other than describing broadening tops and broadening bottoms. But this is a guy that had patents for everything. A brilliant inventor, a brilliant thinker. He was one of the first to design a way of fracking oil wells, but he did it differently than they do today. He did it with liquid nitrogen. And he had a firm called Cryomet, which was a publicly traded company. It was privately held by him, but what they would do is they would basically pour liquid nitrogen and freeze the outer casing outside of the drill and the drill bit that would go down to where they knew that there was oil, but it was in solid rock. And it would freeze it all. Then by setting off small explosions, it would crack everything. The oil would run into the well and they could drill it out. And it was a brilliant innovation. It turned the oil industry around for a long period of time. And he took his private company public. He was very young. He was in his 40s, and he made many, many, many millions of dollars taking it public. Okay, then he decided he was ready to retire. Now, he had all kinds of patents on things like baffles, which are, they deaden vibrations and sound for nuclear submarines, and all kinds of things you can't even think about. They just came out of his head, and he was able to create them and design them and build them and all that sort of stuff. Okay, he decides he's basically going to retire. He doesn't need money anymore, and he wants to know how to manage his money. And so he came to me and we teamed up. This was a long time ago in the 70s. I was still a kid, basically half his age, and he was very young, and I knew nothing. But I knew technical analysis and was studying it very hard. Now, technical analysis is not the cup of tea for most people. Most people on Wall Street, most analysts, more and more it is, because it's so obvious how well it works. But back then it was not. But for an engineer or for a mathematician, it is heaven. It's a playground that the mind can go nuts in and come up with all kinds of great things. So we worked together, we built a company together, and he learned to manage money very well. He told me one day that the reason markets go up is for one reason and one reason only: productivity growth, period. And I said he was crazy, until he started bringing out all the math that proved it completely to me, going back 150 years. Now, a lot of things goes into productivity, but if you can move along with productivity growth of 3%, which you can do and have done for centuries, for whatever reason nobody knows, then what happens is economies grow at approximately 3%. And when economies grow at approximately 3%, what happens is the underlying stock markets that trade at premiums to growth rates. You can do it PEs, price to earnings. Why should something sell at 15 times earnings? Shouldn't it sell at earnings? If a company is earnings X, then X times number of shares should be what it's worth, but they don't. They sell it multiples to that. Why? Because they discount the future. Because if earnings are growing at X, then you want to be on that bandwagon and you're willing to pay more than 1 times X. So if you pay 2 times X, but somebody is willing to go out 3 times, then that's what it trades at. And that's why the stock market in the US is traded as low as 6 times X at the bottom of bear markets, and as high as 80 times X at the top of the dot-com bubble. But it's all this valuation relative to the underlying growth. And that underlying growth is based on productivity. The answer to your question is forget everything else, just look at productivity. which is one reason politics comes into play and nobody understands it, because there's a way to screw up productivity growth. And it's called government, and it's called regulations. It's called making it difficult for innovative people to innovate. And that's my answer.
I like it. I like it. All right. I really want to like end on a joke. Okay.
That was a joke. I made all of that up.
Okay. Well, then I think we'll end right here. Yes, JL, great questions. Everybody, great questions. We definitely meant all of it. Thank you guys so much for everything. This was a fun one tonight, and we get one tomorrow. And everybody have a great day.
Great. Thank you very much, everybody. We appreciate it.
Oh, webinar. Yes.
Oh, yeah.
Go to the website. Okay. Click webinar, self-explanatory. That's all you got to do. Just pay through the links and send me an email that says that you did. Bing, bing, boom. And
if there are those of you who would like to get in with this one-on-one consulting before we have to close it down, remember that all of our consulting clients get all of our webinars from now until forever at 50% off. Thank you very much.
all right, do that so that I don't get a gray hair at 28 years old. Okay, goodbye.
Bye-bye.